Right now, America's banking system is facing a crisis that most depositors don't see coming: hidden watch lists, unrealized losses, commercial real estate exposure that would shock you. And if you're like most people, you're probably banking at an institution you chose based on convenience, not safety. Today, I'm revealing the 5 safest banks in America right now. Institutions where your deposits are protected not just by FDIC insurance, but by fortress balance sheets so strong that failure is virtually unthinkable. But first, you need to understand what most Americans get completely wrong about choosing a bank. Here's the critical truth. When your bank fails, your money can be frozen for weeks, even with FDIC insurance. Most people pick their bank based on convenience, whatever branch is closest. App reviews, sign-up bonuses, interest rates. They assume FDIC insurance up to $250,000 means it doesn't matter which bank they choose. This assumption is dangerously wrong. Yes, FDIC insurance protects your deposits up to the limit. But here's the critical truth. When your bank fails, your money can be frozen for up to 2 weeks, even with FDIC insurance. What happens when your paycheck can't be deposited because your bank no longer exists? What happens when your mortgage payment bounces and your credit score tanks? FDIC insurance eventually makes you whole, but the disruption, stress, and cascading consequences are real. This is why choosing the right bank matters even below the insurance limit. And it's why Warren Buffett, despite having unlimited resources, is extraordinarily selective about which financial institutions he trusts. Buffett has spent over 60 years studying banks. He understands their business models better than most bank executives. And here's what he knows that most people don't. Banking is fundamentally a business of trust and risk management. A bank makes money by taking deposits and lending them out at higher rates. Simple in theory, devastatingly complex in practice. Because the loans a bank makes today may not reveal their true quality for years. A commercial real estate loan that looks sound can become worthless when buildings sit empty. Mortgage-backed securities can collapse when interest rates spike unexpectedly. The best banks prioritize surviving long-term uncertainty over maximizing short-term profits. They maintain capital well above regulatory minimums. They diversify loan portfolios. They resist chasing yield through excessive risk. And they build deposit franchises so strong that customers stay even when competitors offer higher rates. These are the qualities Buffett looks for. These are what FDIC examiners reward with the highest ratings. And these are my criteria for identifying the 5 safest banks. I analyzed the 14 banks that failed in 2023 and 2024. Every single one had commercial real estate exposure exceeding 300% of capital. The average was 380%. My methodology examines 5 factors. First, capital ratios. The regulatory minimum for Common Equity Tier 1 is 4.5%. My list exceeds 11%. Second, commercial real estate below 100% of capital. Third, manageable unrealized securities losses. Fourth, stable deposits. Fifth, conservative management culture. Now let me reveal the 5 safest banks where you should consider moving your money. Number 1, JP Morgan Chase. This may not surprise you, but the reasons go deeper than size. JP Morgan has a Common Equity Tier 1 ratio of 14.5%, more than triple the regulatory minimum. Their commercial real estate exposure represents less than 70% of capital, well below dangerous levels. What truly sets them apart is management quality. Under Jamie Dimon's leadership for nearly 2 decades, the bank prioritizes fortress balance sheet strength above all else. During 2008, while competitors collapsed, JP Morgan acquired Bear Stearns and Washington Mutual at bargain prices. During 2023, while Silicon Valley Bank crumbled, JP Morgan stepped in as buyer of last resort for First Republic. Here's the pattern you need to understand. The bank that rescues others during a crisis won't need rescuing. Their deposit base exceeds $2.4 trillion. Their global operations provide unmatched diversification. And as a globally systemically important bank, regulators will never allow them to fail. If you can only bank at one institution, JP Morgan Chase should top your list. The second safest bank has a fascinating story that explains why Warren Buffett was selling their stock last year and why that actually proves they're safer than ever. Most people got this completely wrong. Number 2, Bank of America. Buffett invested heavily during 2008. Recently, he's been selling shares, which confused many investors, but this reveals an important distinction between investment returns and deposit safety. Buffett sold because the stock reached full valuation, not because he fears failure. Berkshire Hathaway still owns over $31 billion worth, representing 10.2% of their entire portfolio. Bank of America remains fortress strong. Their common equity Tier 1 ratio exceeds 11%. Their deposit base of $1.9 trillion is extraordinarily stable, coming from long-term retail and commercial relationships. They benefit from flight to safety. When regional banks weaken, deposits flow toward the largest institutions. This strengthened their position during the current crisis. Now, the third bank on my list is going to surprise some of you, because unlike JP Morgan and Bank of America, this institution actually made headlines for all the wrong reasons: scandals, regulatory fines, congressional hearings. And yet, counterintuitively, those very problems have made them safer for your deposits today than they were 5 years ago. Number 3, Wells Fargo. This one has baggage. Scandals involving fake accounts damaged their reputation and resulted in a Federal Reserve asset cap constraining growth. But here's the counterintuitive truth. Regulatory restrictions actually made them safer for depositors because they can't grow aggressively, they can't take excessive risks that destroyed their competitors. They've been forced to focus on core businesses, improve risk management, and build capital. The result? Common equity Tier 1 exceeding 11%, prudent commercial real estate exposure, and one of the strongest deposit franchises in America. As a globally systemically important bank, they receive intensive supervision and carry an implicit government backstop. Their problems were operational, not balance sheet issues, and operational problems can be fixed. Number 4, Charles Schwab. Not a traditional bank, but a brokerage giant operating one of the largest banking franchises in America. During 2023, Schwab faced pressure over unrealized securities losses. Stock prices dropped, headlines questioned stability, but the fearful coverage missed something critical. Schwab's business model is fundamentally different. Their deposits are primarily cash-awaiting investment in brokerage accounts, money kept for trading convenience, not yield. During the 2023 banking crisis, while regional banks lost 15 to 20% of deposits, Schwab's deposit base remained remarkably stable. Why? Because their customers aren't rate shopping. They're parking cash between stock trades. They're actively managing their securities portfolio, letting lower-yielding investments mature and reinvesting at current 4 to 5% rates. By the end of 2027, as these lower-yielding securities mature, their unrealized loss problem will have largely resolved itself through the natural passage of time. Their liquidity position is extraordinarily strong. Plus, Schwab offers SIPC protection for brokerage assets that supplements FDIC insurance. Multiple layers of protection exceed what single traditional banks provide. Number 5, U.S. Bank, Minneapolis-based, quietly building one of the strongest regional franchises while competitors imploded. Historically known for conservative management, disciplined growth, and refusing risky lending that destroyed peers. Common equity Tier 1 exceeds 10%. Commercial real estate exposure is diversified across property types and geographies, strong and resilient Midwest markets. Their deposit base is overwhelmingly retail and small business, the stickiest funding a bank can have. No significant deposit flight. Customers stay because they trust the institution and value relationships over marginally higher yields. U.S. Bank also operates payment processing and corporate trust businesses, generating stable fee income regardless of interest rates. Now, before I give you the exact steps to protect your money, let me ask you something. If you found this breakdown valuable so far, hit subscribe. Because next week, I'm revealing the 10 banks that are showing the exact same warning signs as Silicon Valley Bank 3 months before it collapsed. You don't want to miss that if your money is at one of these institutions. What about other large banks? The answer requires nuance. Some major banks are globally systemically important, government protected. Your deposits are safe, but not all large banks are created equal. Some have persistent management issues resulting in regulatory restrictions. They're safe from failure, but not optimally managed. Over time, poor management creates risks even strong capital can't offset. Many people bank at regional institutions believing these must be safe. Compared to failing community banks, they are safer. But compared to my top 5, they carry more risk. Not bad banks, not on watch lists, just not fortresses. Let me pause here for a second because I know what some of you are thinking. My bank has been fine for 20 years. Why should I change now? That's exactly what Silicon Valley Bank depositors thought in February 2023. By March, the bank was gone. Buffett's approach offers the template for your decision. He looks for economic moats, sustainable competitive advantages, protecting market position over time. In banking, the most powerful moat is a stable, low-cost deposit franchise built on customer relationships rather than rate competition. When customers stay with a bank because they trust it, because they value the service, because switching would be inconvenient, that bank has something competitors cannot easily replicate. All 5 banks on my safe list have built exactly this kind of franchise over decades or centuries of operation. JP Morgan Chase traces its heritage back to 1799 through the Bank of Manhattan Company. Bank of America to 1904 when it was founded as the Bank of Italy. Wells Fargo to 1852. These institutions have survived world wars, depressions, financial panics, and every other crisis that history has thrown at them. They will survive the current regional banking turmoil as well. In fact, they'll likely emerge stronger, acquiring the customers and assets of failed competitors at attractive prices, while their own franchises remain intact. Compare this to First Republic Bank. Before it collapsed in May 2023, it had a common equity tier 1 ratio of just 6.8%. Commercial real estate concentration, over 200%. Unrealized securities losses, nearly wiped out their equity. Every warning sign was flashing red, but depositors ignored them. Buffett also emphasizes that in banking, reputation is everything. A bank can recover from loan losses. It can recover from bad investments. It can even recover from regulatory penalties and management scandals, as Wells Fargo has been demonstrating. But a bank cannot easily recover from a loss of depositor confidence. Once customers begin to doubt whether their money is safe, the psychology of bank runs takes over. This is why the safest banks invest heavily in maintaining their reputations, in communicating their strength, in building the perception of permanence that keeps deposits stable during turbulent times. So let me give you the exact steps to protect your money right now. First, download your bank's latest quarterly call report. Look for the Common Equity Tier 1 ratio. Below 8% is a warning sign. If any institution holds more than $200,000 of your money, you're taking unnecessary risk. Second, evaluate commercial real estate concentration. Above 150% of capital, begin planning your transition now. Third, consider consolidating at one of the 5 institutions I've named. JP Morgan Chase, Bank of America, Wells Fargo, Charles Schwab, and US Bank represent the safest options available. These aren't just large banks. They're institutions with proven track records of surviving every crisis thrown at them. You might sacrifice some yield. Some smaller banks advertise rates 0.5% or more higher. But remember Buffett's first rule: never lose money. The second rule: never forget the first rule. Would you rather earn an extra $50 annually or avoid frozen accounts and bounced payments? Fourth, supplement with treasury bills from treasurydirect.gov. Competitive yields with 0 credit risk. Maturities from 4 to 52 weeks give you flexibility. Fifth, remember safety is ongoing practice. Regularly review your bank's financial health. Stay below insurance limits. Diversify across multiple strong institutions. And here's why this matters right now, in January 2026. Interest rates remain elevated. Commercial real estate vacancies in major cities are at 20-year highs. The FDIC's problem bank list just grew for the 4th consecutive quarter. The warning signs are everywhere. Comment below which of these 5 banks you're considering, or if you have questions about your current banking situation. Your financial security depends on making informed decisions about where you keep your money. Here's what Warren Buffett understood that most people miss. In banking, survival isn't about being the smartest or the fastest. It's about being the most boring when everyone else is trying to be exciting. The safest banks are the ones that say no to easy profits today to stay standing tomorrow. Remember what I said at the beginning about FDIC insurance protecting your deposits but not protecting you from the chaos of a bank failure? That 2-week freeze, the bounced mortgage payment, the damaged credit score? The 5 banks I've shown you today eliminate that risk entirely. The banks on my safe list won't just survive the current turmoil. They'll thrive while their competitors fail. By moving your money to these institutions now, you're not just protecting your deposits. You're positioning yourself with the institutions that will emerge stronger on the other side. Don't wait for the next crisis to make you wish you'd acted sooner. The safest move you can make is the one you make today. Watch another video here to stay ahead of what's coming next.